to my mind, there's two really important deadlines which we have to think about for the U.S. domestic solar outlook from a project development perspective, and reconciling how the tariffs and the recent policy changes will ultimately weigh out. The first is December 31st of this year. And if you are able to establish that you are starting construction before December 31st of this year, you don't need to comply with the new foreign entity of concern rules, which means basically you can procure your inputs from anybody who you would like to, right? You don't have to participate in the new restrictions. The second deadline to watch is July 4th, 2026.
Just to add a little bit of color on something that Herbert also touched on, we've done some math on what the taking away the PTCs means for PPAs, and we expect that if, let's say, you take an average PPA of $50 a megawatt hour now, if that rises by $15 a megawatt hour, a solar project is still meeting the return targets of utilities. And that's not a crazy, so going to 65, that's not crazy in an environment where tech companies are pushing so much to build power projects.
I think where we can begin is what caused the stock to drive down more than 30%. So the company unexpectedly reported results for the second quarter on Monday. They were supposed to do that on Wednesday. And that came with a 60 billion kroner capital increase. So that's roughly $10 billion or around 8 billion euros. And just for context, that is roughly 46% of what their market share was.
Just to give one vignette of this, there's a great report out in Ember earlier this week that Chinese solar cell exports are up significantly this year. So cell versus panel. And a lot of those cell exports are going to India, because in India now they have better module and panel manufacturing capacity, and they're using those Chinese cells to then sell into the U.S. markets, right, as finalized products. So there's a lot of dexterity and nimbleness in global supply chains, and I think over the next 2 or 3 years we'll see some creative ways that folks access the U.S. market.
Orsted will now dedicate roughly 40 billion of that 60 billion capital increase into fully funding Sunrise. We don't see a clear exit strategy for Orsted. They will probably need to hold the 100% of the asset throughout. So that means that the company, once we look ahead into 2028, there are very few growth options, at least in the US. So there might be a shift in capital allocation.
Good morning, good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange. Today we've got a special guest. We've got Herbert Crowther from Eurasia Group joining to chat about a number of things. And we also have several folks from the BI side. We've got Patricio Alvarez joining from vacation in Spain right now, and he's hopped on quickly to talk about the latest developments at Orsted. We also have João Martins, also from the European Utilities team, and Nathan Dean calling in from our DC office. So that's the crew for today. And given it was in the news earlier this week and we've seen a big reaction in the share price, Patricio, I just want to come to you first. Can you give us a quick rundown on what's going on with Orsted and why do we see such a substantial move in their price earlier this week?
Sure, thanks, Rob. So I think where we can begin is what caused the stock to drive down more than 30%. So the company unexpectedly reported results for the second quarter on Monday. They were supposed to do that on Wednesday. And that came with a 60 billion kroner capital increase. So that's roughly $10 billion or around 8 billion euros. And just for context, that is roughly 46% of what their market share was prior to the announcement. The reason that the company moved ahead with the rights issue of this size is because it's not our theories, it is management's statements that it was tariff pressure. So supply chains have become very difficult for business, and also the U.S. policy reversal, so a less friendly administration towards offshore wind specifically, and also the sunset or earlier sunset of the tax credits also meant that the M&A market for offshore wind in the U.S. Came to a standstill. And why does this matter for Orsted? It's because the company relies on selling parts of it, selling stakes in the projects under development in order to keep funding them and de-risking the balance sheet and sort of keep investing in growth and crystallizing value on their assets. So this meant that the company could not own a 50 or 49% stake on Sunrise Wind in the US, which it still remains on track to be built by 2027. But that was the crux of the issue. It's that a reversal in policy, a very tough landscape in terms of costs and supply chains for offshore wind in the US meant that Orsted could wait no longer and issue an equity ticket of this size. In terms of the, let's say, the forward-looking outlook, we still think that both of their projects, so that Sunrise Wind and Revolution Wind in the US, are still under or exposed to risks of cost overruns. Orsted will now dedicate roughly 40 billion of that 60 billion capital increase into fully funding Sunrise. We don't see a clear exit strategy for Orsted. They will probably need to hold the 100% of the asset throughout. So that means that the company, once we look ahead into 2028, there are very few growth options, at least in the US. So there might be a shift in capital allocation. And we do note that the company still relies on the sale of two assets. So that's Greater Changhua in Taiwan and Hornsea 3 in the UK, which it still needs to sell down to be able to keep the leverage under control.
Fantastic. Thank you, Patricio. So, Herbert, I want to get you into the conversation. For anyone who doesn't know Eurasia Group, they spend most of their time thinking about geopolitical risk and just parsing what Patricio just said. I know you don't specifically think about Orsted, but I'm wondering if you can frame for us kind of the tariff landscape in the U.S. How are things really going to unfold there? What's going on with the offshore wind industry? And I would note, Patricio was talking about how the funds from the equity raise are essentially going to go into a project in the U.S. I think that's the kind of thing that the Trump administration likes to see. So is this a good thing or not? Anyway, frame the sort of broader macro policy landscape as you're thinking about these kinds of things on the U.S. front.
Thanks, Rob. Great to be here with everyone today and to start out with such an easy question as summarizing where we are for tariffs across the board. For offshore wind, from our perspective, we've been really flagging that it's important to keep the 1 or 2 year time context in mind, right? Especially for the US specifically. Offshore wind's been going through a difficult period even before the recent election and before recent policy changes, for example, in the One Big Beautiful Bill. And it's an area where the federal government has even more leverage and control over whether or not new projects can go forward compared to other areas of renewable projects, for example, onshore solar. So even going in, for example, at the beginning of this year, offshore wind was one where tracking the space, it was easy to have a relatively confident view that headwinds would be mounting. The implication for that, I think, is just a very difficult outlook for any new offshore wind projects over the next 2 or 3 years. Like I said, though, even moving over the last 24, 36 months, this type of direction of travel was already starting to emerge. So it's not necessarily exclusively about recent policy changes. More broadly, though, for energy in the U.S. and our outlook on renewable deployment, I think the two big pillars that we're tracking and monitoring on a pretty high intensity basis are, number one, the tariff outlook, which impacts, for example, a lot of green energy imports from China and other suppliers. And then number two, the energy policy changes, which we just had in the One Big Beautiful Bill in early July. And there's a lot of complexity and nuance to unpack there, which we can in the future, particularly with regard to quote unquote foreign entities of concern and their ability to participate in U.S. green supply chains. But I think we can say, as a general rule of thumb, that all of the tariff headwinds and policy changes are difficult for U.S. green supply chains to adapt to, but there are still ways forward. They just require even more sharp geopolitical insight potentially than in the past.
Yeah, maybe to follow up, and maybe this is a sort of too simple of a bifurcation, but I kind of look at, if you think about wind and solar and you just sort of put them into two buckets, my sort of general rule of thumb right now is that wind is going to have a difficult time over the next few years. I think solar is less challenged, even with some of the FEOC changes that maybe you mentioned. But do you agree with that? And kind of give us a sense of what this sort of successful supply chain looks like for solar in the U.S. I mean, we've been banging the drum that First Solar actually has as a company done pretty well with all the changes, but are there other names you're thinking about there as well in that mix?
Yeah, I agree with that overall view fully, Rob, that the outlook for solar is certainly better than wind over the next 2 or 3 years in the US. It seems like the president has a particular personal affinity towards blocking wind projects, even more than solar. Now, over the last few weeks, we've started to see more data points specifically targeting solar than what we saw even during the first term, right? So that's a bit of a shift, and we still have to see how that will play out over the next few months. For example, we have some guidance which we're still waiting for from the Department of Treasury on the rules surrounding safe harbor and a number of other data points, which will be very pertinent to U.S. solar deployment over the next 2 or 3 years. From a supply chain perspective, there are still a number of pathways for the U.S. to have a robust domestic ecosystem. You mentioned First Solar, definitely. In addition to First Solar, Qcells, which of course is part of Hanwha Group, the Korean manufacturer, has had a quite aggressive and ambitious domestic build out in the U.S. recently. And there's also a larger group of global aspirants in the solar supply chain, which are to varying degrees cooperating or not cooperating with Chinese manufacturers. And a lot of those new ventures and new producers are ultimately hoping to access the US market. Just to give one vignette of this, there's a great report out in Ember earlier this week that Chinese solar cell exports are up significantly this year. So cell versus panel. And a lot of those cell exports are going to India, because in India now they have better module and panel manufacturing capacity, and they're using those Chinese cells to then sell into the U.S. markets, right, as finalized products. So there's a lot of dexterity and nimbleness in global supply chains, and I think over the next 2 or 3 years we'll see some creative ways that folks access the U.S. market.
Maybe just a quick follow-up on strategy in the solar space. And in my mind, the industry under the Inflation Reduction Act had a lot of incentive to build out that domestic supply chain. And those 45X survived, but a lot of the other stuff got rolled back. You have these new foreign entity rules, but at the same time, you have a lot more tariffs. So in your mind, do the tariffs ultimately help build some of that supply chain? Do they make up for any of the weakening of incentives from the IRA?
They may. To my mind, there's 2 really important deadlines which we have to think about for the U.S. domestic solar outlook from a project development perspective, and reconciling how the tariffs and the recent policy changes will ultimately weigh out. The first is December 31st of this year. And if you are able to establish that you are starting construction before December 31st of this year, you don't need to comply with the new foreign entity of concern rules, which means basically you can procure your inputs from anybody who you would like to, right? You don't have to participate in the new restrictions. The second deadline to watch is July 4th, 2026, so just under a year from today. And if you start between December 31st of this year and July 4th of next year, you can still claim that ITC or PTC for the full runway. However, you need to comply with the foreign entity of concern thresholds. So then it becomes more difficult to procure the fully American-made panel that lets you qualify in that window. To me, the interesting question mark is once ITC and PTC for solar phases out at the end of 2027, we will still have solar projects going forward in the US, right? They just won't be claiming ITC or PTC. That means PPA prices need to go up. That means we need to sort of rearrange the terms of those deals in some way. But if you're not claiming ITC or PTC, you don't have to deal with the foreign entity of concern rules, right? And that's separate from manufacturing on the 45X side, right? That's a different ballgame. But we still have a question mark over once we go through this initial rush, and everyone's rushing right now to meet that July 4th, 2026 deadline, what's the post cutoff equilibrium for the next phase of US solar projects? And there, I think we could see the emergence of new domestic players that can feed those projects. The producers can claim 45X, and the developers can still be bankable in 28, 29 without ITC or PTC. But to be quite candid, we haven't done the math on that yet, and that's a pretty complicated equation.
I love all the nuance here. This is getting very challenging to kind of think through all the twists and turns about clean energy development here in the U.S. Nathan, I want to bring you on and get perspective on an additional twist and turn. You know, we've been hearing rumblings about a so-called reconciliation 2.0 and perhaps another attack at tax reform. Tell us what you're hearing on that and whether folks should be concerned about that, especially thinking about some of these clean energy incentives.
Yeah, so just to confirm, can you hear me? Okay, great. So the one big beautiful bill was passed via reconciliation. And for those of you who aren't familiar, it's a process in which you essentially think of it as a budget resolution. So the House of Representatives passes it, the Senate passes it, and you can bypass the filibuster. And it's a way that you can actually put legislative goals into action without getting past that 60 vote threshold in the Senate. Now, there's some weird rules about this, and one of the rules is that you can only do it once per fiscal year. Well, the US government fiscal year ends on September 30th. And so between next year, before the midterm of the elections, in fact, you have two more opportunities because you have 2026, and then you would have after September 30th, 2026, you can do another reconciliation. Now, it's actually being called too big, too beautiful is what we're hearing from the White House, which makes me think of MC Hammer. But what we're telling our clients is when it comes to the reconciliation idea 2.0, you're going to hear two things. From the solar side, you are going to hear from policymakers, and we've already started to hear this a little bit from those policymakers that were fighting for the IRA tax credits. And some, obviously those were, withdrawn in a way that the solar industry wasn't happy about. But now policymakers can come back and say, well, let's actually see what's happening here. Let's see if we can actually get these back in. So you're going to hear talks, statements like that. But at the same time, you're also going to hear statements saying, look, we didn't go far enough. All of these, we just rolled them back, but we need to just get rid of them in its entirety. So where I'm going with this is there's going to be a lot of rhetoric, but I don't think you're going to see many chances of reconciliation or for a package to come together and actually pass next year. The reason being is, look, if it was easy, it would have gone in reconciliation 1.0. Now they're getting to the hard part. And secondly, don't forget, we're entering an election year. So if we were to have this call, say, April or May of next year, my message to you is most of these folks on Capitol Hill are right. They're saying, right, I'm done for the year. I'm going to go campaign because a lot of them are running against folks, just essentially, every member of the House of Representatives, 1/3 of the Senate. And for every day they're here in Washington, their opponent is back in their home state or their home constituency. And so usually in an election year, midterm election year, after about April, May, they're like, get me out of Washington. I don't want to be here. So a lot of political rhetoric on this reconciliation, too big, too beautiful. But again, I don't think you're going to see much of it. Like Herbert was saying, I think most of the changes are going to have to come from Treasury, the IRS, and those data points that he was referring to. So those are the things that are more important to watch.
Thanks, Nathan. Zhao, I want to quickly bring you into the conversation. Now, I wasn't expecting to hear an MC Hammer reference if you want to swap notes afterwards, I'm happy to sort of give you the history there. Zhao's a little bit younger. So Zhao, are your companies looking beyond just Orsted? You cover a lot of European renewable developers. They had been active in the U.S. How concerned are you about all of this shifting political landscape that Herbert's been talking about and Nathan's been talking about? Is it affecting their investment strategy? Are they going to be pulling back from the U.S.? How do you see things evolving for them over the next 12 to 18 months?
Yes, it is affecting them. Let me just start by saying that as I think the call progressed, it's very obvious that Orsted is the most exposed. They are the poster child of offshore wind development, and that's the area where the biggest risks ever risen this year. On the other side, onshore is progressing a bit more steadily. We cover companies that in the US are mostly focused on solar development now. They've done wind for many years, but they've shifted their capital plans towards developing solar over the last 3 to 4 years. And as we alluded to, that's a subsector of renewables that is doing relatively better. Actually, a lot of the developers that we cover have recovered, their share prices have recovered significantly this year. And that's led by two things. Number one, even though policy is now worse than under the IRA, the clarity that we have going forward is very important for these developers. It allows them to reset their capital plans for the next 2 to 3 years. And what we've seen there are divergent paths. We've seen most of the companies have scaled back investments in the US, something between 20 and 30%, excluding Orsted. So still a scale back, but they are still investing. They are still trying to capture some of these tax credits. And just to add a little bit of color on something that Herbert also touched on, we've done some math on what taking away the PTCs means for PPAs. And we expect that if, let's say, you take an average PPA of $50 a megawatt hour now, if that rises by $15 a megawatt hour, a solar project is still meeting the return targets of utilities. And that's not a crazy, so going to 65, that's not crazy in an environment where tech companies are pushing so much to build power projects. On the wind side, that's much worse. We expect PPAs need to go up at least $25 per megawatt hour. But so to focus on the two largest peers that we cover, EDPR is committed to their 2.5 gigawatts of new solar capacity in the US over the next 2 years. And after that, they've left it open, I think, waiting for a little bit more clarity on the rules regarding on the rules that will come out in August. Acciona, on the other hand, which is a peer that we are increasingly positive on, they've actually canceled or halted the construction of 2 battery projects in the US, citing tariff risks. So that's the other side of the picture, not just the IRA repeal, but also tariffs.
Okay, very interesting. I like this emerging consensus that PPA prices could be set to increase here in the US. In many ways, that could be good news for developers or folks in the solar supply chain. And maybe just to tie it into a piece of research, just the other day, Patricio and I put out a note on the surge in AI data center CapEx and the likely increase in power demand that will result from that. Some pretty big numbers coming down the pipe here in the US. So if you're not paying attention to the data center story, it's one that we think you should look at. And we think it provides upside to consensus for some of the US exposed solar names. And very interesting to note, a lot of the hyperscalers are relatively price insensitive. They want power. They want it today. They're willing to pay a premium for it. So maybe it aligns with a little bit with this story that we've heard. So Herbert, I want to come to you because I think you've also been thinking about this topic, and I want to get your perspective on that idea. Do you think the AI data center piece plays into the potential for rising PPA prices? And I also want to get your perspective on the difference between how China's thinking about AI and how the US is.
Sure. I agree fully with you, Rob and Joao, on the U.S. sort of electricity demand side of this, and want to call attention specifically to batteries, separate from solar, because batteries are being treated substantially different than solar under the One Big Beautiful Bill, and as particularly for the hyperscalers, particularly for new data centers, the most attractive short-term thing which they can add to a new facility for a fraction of the cost of the total apparatus of the project is on-site batteries, right? Batteries under the One Big Beautiful Bill have retained their full runway for both ITC, PTC, and manufacturing production credits. However, they have a more difficult pathway for the amount of foreign entity of concern suppliers that you can have in a project. So the way I've been describing this in many conversations over the last few weeks is that the degree of difficulty for battery manufacturing is now much higher, but the potential benefits of successfully establishing a domestic battery producer that can, with high confidence, meet those thresholds is extremely high. In many ways, probably going to be more lucrative even than solar producers that can operate in that space. So we'll have to see how that supply chain sort of reorganizes over the next few months. In my view, the battery supply chain is more difficult to reorganize away from China than the solar supply chain is, particularly with the upstream materials. But like I said, because the incentive's higher, I think we'll still see lots of innovation on the domestic front there. The China data center electricity story is quite fascinating, and I've found relatively undercovered because it's so different than the U.S. data center power story. In the US, we're fixated on power as a constraint to new data centers, that new data centers, just even for whatever price, they can't procure enough power as they want. In China, that's not the issue, right? There's plenty of power available in the system. But what we are starting to see, particularly so far this year in 2025, is both the central government and local governments putting more restrictions on the ability of data centers to consume energy writ large, because they don't want them to be too emissions intensive, and they don't want them to cause problems for the local emissions intensity and energy intensity targets of the 5-year plan. And they're trying to push more of these data centers to the northern and western provinces where we have overabundant renewable supply, and as a result, make those data centers demand sinks for new renewable projects. So in many ways, it's a total reverse of what we think about in the US, where data centers would like to buy any electricity they possibly can. In China, the new mentality is restrictions in terms of what type of electricity these facilities should be consuming. We have some great research on this at EG if anybody on the line wants to read. It's quite interesting and quite counterintuitive compared to our US perspective these days.
Yeah, fantastic. On that front, for anyone who doesn't have Herbert's contact email, just shoot me an IB. I'll gladly share the ability to get in touch and how he can help you get access to some of those reports. Maybe a quick follow-up. The conversation in the US around data centers, you hear a lot of mention of nuclear power. Now, I think we're a bit skeptical that nuclear power works on the timeline that the data center folks want to move at. The hyperscalers want power yesterday, not in 10 years' time, by the time you could get nuclear developed. But maybe in China, the story's a little bit different there. So do you see a bifurcation, and kind of how do you think about nuclear playing into this sort of broad sort of description of energy dynamics you were describing?
On the China side, nuclear is a funny one because they're permitting basically the same number of projects every year, 10 reactors every year. They build these reactors on time, on budget. The supply chain is predictable, but there's really not a very serious push to make nuclear the core of the China energy story. Ultimately, it's quite peripheral in the broader China macro energy analysis environment, right? So there is not a connection really between data center power demand and nuclear projects going forward in China the same way there is in the U.S. The U.S. version of this story is more difficult to parse. In the short term, I think it's very analytically safe to say that data center power demand is driving longer lifetimes of existing nuclear plants and making the recommissioning of recently retired plants more possible. Whether we're going to see a new AP 1000 approved and really see shovels in the ground over the next 2 or 3 years is much more difficult, I think. It's possible, but still not necessarily very high likelihood in the near term. We still might need to see even more pressure on the power demand side of things before you find a utility willing to take that risk.
Maybe another question on the U.S. side. So gas has been part of the narrative for a very long time here in the U.S. And I think to meet some of this incremental load, quite logical that gas continues to play a pretty big role. It's the quintessential bridge fuel. At the same time, if you're looking at GE Vernova, for instance, they've got a multi-year backlog. You call them up, you say you want a gas turbine, and they say, great, we can sign you up for maybe 2030 at this point, possibly a little faster if you're the right customer. But I'm curious, could we see China or other sort of foreign entities play a role in getting more gas turbines into the US? Because there's plenty of gas supply here, but the turbines are the constraint, or the CCGTs.
Yeah,
what do you think on that?
That's an interesting thought, Rob. I haven't heard that come up, particularly from conversations with Chinese folks on this issue. I presume they would probably face the same tariff rates unless they got a special exemption for that as the broader categories of tariffs. But what you're getting at there in terms of the difficulty of even if the administration really wants gas and coal to meet the majority of the new demand delta, to me, it seems like still a question mark looking 3 or 6 months from now. If we have more data points suggesting that is going to be difficult, that there's no huge rush of turbines looming around the corner to make that pathway feasible, does that incentivize the administration to moderate a little bit on some of the anti-solar and anti-wind policies we've seen over the last few weeks? I'm not sure, perhaps even internally, there's no clear consensus on that. But I think that's a scenario which can still go multiple directions over the next few months as the politics of power prices and the relevance of this as a broader issue becomes more pertinent.
I got to follow up. So you mentioned coal, and coal is so out of the mix in recent years, but I know the administration's been talking it up, and I think there is a little bit of a bump up in coal generation here in the U.S. this year so far. In 5 years, what do you make of this? Are we going to see really more coal, whether it's to fuel data centers or for any other purpose? Can the administration really turn around the narrative on the coal story here in the U.S.?
We're still pretty skeptical that we're going to have a coal renaissance under the second Trump administration, just as it was under the first Trump administration. But it's a similar story to nuclear, where at this point, baseload power in the U.S. that's connected to the grid, permitted, reliable, is almost impossible to retire. So 3 or 4 years ago, there were, if you look at the EIA data, there was a robust pipeline of coal retirements looming in the U.S. At this point, most of those plans have been shelved. And if you combine the tariff uncertainty for green technologies plus the turbine backlog on the gas side, the inevitable result of that picture is more lifetime extensions for existing assets, including coal, including nuclear, including gas. I guess to again bring it back to the solar and battery side, does that mean that you also inevitably, despite the political pressures, end up with a softer stance on solar and batteries just for a energy system modeling perspective? I'm not sure, but it seems possible.
Fascinating. Zhao, I want to come back to you for a reaction to that. So Europe has been very vocal and aggressive about retiring coal. In the US, we're talking about extending coal, keeping it around for longer, as Herbert just described. Is Europe continuing to make progress on coal retirements? Are they revisiting any of those plans, especially following the Russia-Ukraine crisis and what it did to gas markets over there?
Yeah, so in Europe, coal is going away, and that's never going to change. I think that's the easy answer. We can speak about whether nuclear will be fully phased out in certain countries, how much renewables can grow, but I think consensus is that coal is going to be phased out completely. Several countries already phased out, like the UK, for example. We're I think phasing out both last year and this year 15 gigawatts a year of coal. That's funny enough being replaced with gas, which is a fairly expensive source of fuel here in Europe. But there are no plans to not phase out coal. The only thing that I would say is because we see renewables penetration reaching a point where in certain countries it's already at kind of an optimal point. In certain technologies, the growth is not meeting the targets that the EU would like for. We speak about offshore problems in the US, but in Europe, it's not much better. The last few auctions didn't have any good results. And so the only thing that we flag is that if we don't progress the renewable build out as fast as we could, and given the gas supply constraints that we have, that might mean that some of the coal phase out later in the decade might be delayed, so that we can have a more robust supply mix, power supply mix. But the ultimate goal of phasing out coal-fired is not going to change in Europe.
Let me just hit back on you just real quickly there, because you and Patricio have a note out earlier this week looking at the role of nuclear, particularly in the UK, for helping to meet AI needs. And I'm just curious because nuclear keeps coming in behind schedule, way over budget in Europe and the US, basically the West generally. It's the opposite of what Herbert was describing there in China, where they're just building the same plant over and over, and they're building a certain amount per year. They're coming in on time. They're coming in at a reasonable cost. I don't think we're seeing that in the West at all in any market. But you tell me, is there a case to be optimistic about nuclear in Europe?
So yeah, when Herbert was speaking about China, it almost made me laugh that they have no delays and no cost overruns. Here in Europe, it might be a decade or more of delays, and the budget might triple for any given project. In that sense, we've not seen evidence that it has changed. But I would say, so in Europe, the general nuclear outlook is that the EU is targeting about 110 gigawatts by 2050 versus slightly less than 100 now. So the growth prospects are not huge. And a lot of the new additions will be to replace older plants, especially in France. On the side of small modular reactors, we don't see a lot of upside until the 2035s, and maybe starting there and growing a little bit, but it's still a little bit unclear. So we think nuclear will broadly have a role in the European supply mix for about 15 to 20% of the share of generation going into 2050 versus 25% now. So not a lot less, but it's just not quick enough to meet the AI demand needs. And in Europe, at least, there's no evidence that we can do it with no execution hurdles.
Yeah, fantastic. Okay, thanks for that perspective. Herbert, I want to come back to you, and I know we've run over, so we'll try to wind this down here. But I want to get your reaction to what Zhao just said. But we also have a couple of client questions, but I'm going to give you one that I think is relevant for thinking about US and Europe, and it's probably not a factor in China, but it's like, can you speak to how permitting plays into your thesis, right? I think permitting is a problem in the West for all types of energy infrastructure, but give us your read on how that's playing into the calculus on these various kinds of projects folks may want to be doing?
Sure. So I can't speak much to the European side, but of course on the US side, I can speak a little bit. So the permitting issues for nuclear, of course, are large. It's quite complicated to get a site approved for a new nuclear project. The implication of that is that if we are to see a fully new reactor announced, there are a few sites in the US that have already been permitted previously because there were ideas to build there or build additional reactors at a site where there are already reactors today. And those have a much more feasible permitting timeline and outlook compared to, for example, a fully new site. But then you still have to deal with the labor force issues, the supply chain issues, the general technology issues. The only recent data point we have in the US is Vogtle units, 3 and 4 in Georgia. And that's, a lot of people have different views on exactly how to explain the delays and cost overruns at Vogtle, but they were large, and there's still, uncertainties in terms of if there was a new reactor, another AP1000, how large would the improvements be in terms of time and cost? And that's very difficult to project. On the permitting side, for the US more broadly, separate from nuclear, there are, there's still interest in Congress in doing some sort of bipartisan permitting deal. It's an issue which I follow less closely than some other folks on our team, just because it seems like it always comes up and then it never quite gets over the finish line. But perhaps it's possible at some point in the next 12 months. And if that were to happen, of course, most permitting packages would also include benefits for solar, wind, batteries, transmission, in addition to perhaps as well gas and coal. So in general for the US, any permitting package should be positive for energy across the board. It depends who exactly holds the pen on it, I suppose, in terms of which fuels benefit most.
All right. Well, I think we'll leave it there. I think it's been a very fun discussion. So again, reach out to me if you want to have me put you in touch with Herbert. And thank you so much for joining us. I know it's you're on holiday. You're calling in from a sort of beautiful location in Europe. So thank you for taking some time out to come and chat with us. I think it's been a very interesting and helpful conversation. For everyone who's listening, we hold these calls every week on Wednesday at 10 a.m. New York, 3 p.m. London, 4 p.m. other European time zones. So make sure you join us every week, and we look forward to being in touch. If you want to follow up on any of this, just reach out over IB to any one of us, and we're happy to get you pointed at any of the research or data that we discussed here on the call today. Thank you. Take care. Thanks a lot. Appreciate it, Herbert.
Thanks, Rob.